Here we go again for another round of Pension Pursuit. It's the game where taxpayers, young and old, face off against their own state politicians and state employees. In previous rounds, we learned how state politicians are effectively borrowing money from state employee pensions in order to balance their budgets. They do this because the other ways to cover budget shortfalls, raising taxes and cutting services, would make them less likely to win re-election. We've also learned why it's a bad idea to underfund pensions for the sake of current spending and operations. It puts taxpayers at risk for much higher taxes and reduced services to cover the retirement costs of state employees. What's more, state politicians are able to hide that risk from taxpayers. In this round, we'll see what's wrong with the assumptions that state politicians are making. The million-dollar question: how can state and local governments expect to earn a 7.75% compound annual rate of return on their pension investments? Where does this assumption come from? Well, it comes from historical experience. Annual returns on government bonds and common stocks from 1926 to 2014 realized quite high returns. Long-term bonds had an average annual return of 5.75% during this period. Common stocks returned an average of 10.1% between 1926 and 2014. Pension funds received roughly 8% returns by putting 40% of their money in long-term bonds and 60% in stocks from the 1980s to the mid-2000s. In fact, pension funds did double their money every 10 years during this time. So why isn't it perfectly reasonable to assume that public sector pension assets will continue to grow at almost 8% per year for the foreseeable future? There's an old financial adage that fits perfectly. Past performance is no guarantee of future performance. A big problem is simply that bond yields are much lower than they were in the past. Bond yields are between 2% and 2.5%. Even if stocks continue to return their historical performance, which few believe is likely to happen, then they would need to increase to 72% of the portfolio. This is what states have been doing, along with augmenting their portfolios with investments in private equity and real estate. All of these investments are riskier than bonds. Achieving an 8% annual return not only becomes a lot less likely, by necessity, it becomes a lot more risky. Now, the way professional financial analysts and practitioners view the market is that over the long run, there are a range of possible outcomes, good and bad. They have developed models to try to illustrate the likelihood of any given return being achieved over a given time period. These models suggest that even a 7.75% annual return achieved over 30 years has about a 25% chance of being realized. The basic premise is that the more the targeted return exceeds the risk-free rate, the less likely it is to occur. So given these new market conditions of very low bond yields and highly likely lower returns from the stock market, how have public pension systems responded? In a nutshell, they will have elected to take on more risk to try to achieve the 8% or so annual returns they've been accustomed to. Risky securities do especially badly when the private economy is also performing badly. This works like a double whammy. If the economy is bad, then assets in the pension funds will perform poorly. Basically, once state politicians are unable to balance their budgets by borrowing from pensions, they'll have no choice but to raise taxes or cut services, or both. And this will likely come during an economic downturn, which places additional stress on taxpayers at a time they're already hurting. Shouldn't state and local governments do exactly the opposite in order to ease people's tax burdens when they need it the most? In the next round of Pension Pursuit, we'll take a look at how much money is really owed to government employees and how the size of liabilities matters a great deal.